The trading floors are quiet this Sunday evening, but beneath the surface, Wall Street is bracing for what may become the most volatile earnings week of the decade. As the sun sets over Silicon Valley, three tech titans, Tesla, Google, and Intel, stand at crossroads that could redefine entire industries. This isn't just another earnings season. It's a $2 trillion valuation battleground where AI ambitions, manufacturing revolutions, and computing's future will be stress-tested under the harsh glare of quarterly results. What makes this week extraordinary isn't just the magnitude of these companies. It's the precise collision of technological, economic, and geopolitical forces. Tesla's autonomy claims facing make-or-break validation. Google's core business model, battling AI disruption from within Intel's last credible chance to reclaim semiconductor leadership, all unfolding against a backdrop of Fed uncertainty and escalating tech Cold War tensions. The Tesla crucible, more than just deliveries. When Elon Musk takes the earnings call Tuesday afternoon, analysts won't just be counting cars. They'll be judging whether Tesla remains a growth story or devolves into another automaker. The key metrics tell the tale. The bull case. Market cap $1.2 trillion. Robotaxi network announcement. In August, FSD adoption. Crossing 1 million subscribers faster than expected. The bear trap Q2 deliveries miss. Again at 485,000 versus 50,000. Whisper number. Energy business growth stalled at 12%. Musk's XAI venture, siphoning talent and focus. But the real fireworks may come from what's not in the financials. Regulatory probes into FSD safety claims. Texas, gigafactory unionization threats. Rival robotaxi launches from Waymo Cruise. This earnings call could determine whether Tesla still deserves its 10x revenue multiple or faces the same valuation reckoning as Meta in 2022. Google's existential AI dilemma. Thursday's report marks Sundar Pichai's toughest report card since taking the helm. The numbers will reveal whether Google is successfully pivoting from search ads to AI services, becoming the next IBM, a legacy giant disrupted by its own invention. What the street needs to see. Gemini enterprise revenue exceeding $30 billion. YouTube Shorts finally monetizing at TikTok levels. Cloud growth re-accelerating past 25%. But the subtext is darker. Internal leaks suggest 20% of search queries now handled by AI, cannibalizing Google's cash cow. The innovator's dilemma has never been more real. Intel's final redemption arc. Friday's earnings represent Pat Gelsinger's last credible chance to prove Intel can compete in the AI era. After burning $50 billion on failed foundry attempts, the 18A process must deliver 2-nanometer yields above 80% versus TSMC's 85%. Microsoft OpenAI design wins worth $5 billion, plus data center revenue growth turning positive fail here, and Intel risks becoming the Westinghouse of chips, a former pioneer left behind by nimbler rivals. The macro wildcards. This earnings superstorm hits during peak uncertainty. Fed decision. Wednesday could hint at September cuts. Q2 GDP expected to show sharp slowdown. China may expand Micron ban. Roiling semis. The VIX at 25 signals. Traders expect 3 times normal volatility, with potential single-day moves of Tesla, plus or minus 11%, Google, plus or minus 6%, Intel, plus or minus 9%. Why this week changes everything. These earnings won't just move stocks, they'll answer fundamental questions about our technological future. Can legacy tech giants successfully pivot to AI? Will the market continue rewarding vision over profits? Is the US semiconductor comeback real? As the algorithms prepare for Monday's open, one truth emerges. After this week, the tech landscape may look radically different. Buckle up. Key times to watch. July 22nd, 4:05 p.m. ET, Tesla call, watch for Robo-Taxi Day teaser. July 23rd, 4:15 p.m. ET, Google's AI monetization metrics. July 25th, 4:30 p.m. ET, Intel's yield disclosures. This week represents the most concentrated tech earnings risk event since the 2022 market crash, with 3 industry-defining reports compressed into just 72 hours. The combined $2 trillion market cap at stake here exceeds the GDP of Italy. That's how pivotal these next few days will be for global markets. We're not just analyzing companies, we're stress testing the core narratives driving this bull market. Tesla's valuation as an AI robotics play versus auto manufacturer. Google's ability to monetize AI without cannibalizing search. Intel's viability as a foundry competitor to TSMC. The VIX at 25 signals extreme tension. This is 40% above the 2025 average. Market makers are pricing in moves that could wipe out or create over $300 billion in shareholder value in after-hours trading alone. What makes this particularly dangerous? The macro backdrop. These reports land between a Fed decision and GDP data, creating a volatility sandwich where earnings reactions get amplified by macro flows. Portfolio managers are already on edge about September positioning. Quant funds have reduced liquidity for summer trading. Most concerning? The options market shows extreme gamma positioning around all 3 names, meaning moves could become reflexive as dealers hedge. This is the type of setup that caused the 2021 meme stock mania and 2022 Nasdaq flash crash. Tesla's report is really 3 reports in one, which explains the 11% implied move. The auto business, bear case. Delivery math suggests 487,000 vehicles requires 95% factory utilization. Cybertruck margins likely still negative -15% per teardown analysis. Energy storage growth slowing 12% versus 18% last quarter. The AI business, bull case. FSD adoption curve is accelerating. We estimate 1.2 million subscribers at $99 a month. Robo-taxi network announcement expected in August. Regulatory filings show test fleets in 12 states. Dojo supercomputer now handling 40% of AI training versus 5% last year. The Musk factor, wildcard. XAI fundraising could signal distraction risk. Texas Gigafactory UAW vote scheduled 3 days after earnings. SEC subpoenas regarding 2024 autonomy claims. The trade setup is fascinating. Market is long vol, put-call ratio 1.5 to 1. But short interest at 3-year lows. Gamma wall at $300 suggests violent move if breached key levels. $275 equals 200-day moving average, must hold. $310 equals all-time high breakout. Most concerning. Tesla's weighting means a 10% drop could drag SPX down 1.5% instantly. Google faces its IBM moment. Will AI eat its core business before new revenue can replace it? Here's the breakdown. Search advertising, the cash cow. Q1 growth slowed to 4.2% versus 7% in 2024. 20% of queries now handled by AI, internal leak. Retail search ad budgets shifting to TikTok, Amazon Gemini AI, the hope. Enterprise adoption at 35% of Fortune 500, but monetization unclear. Most are on $20 user pilot programs. Coding assistant winning versus GitHub Copilot, 55% market share. YouTube Shorts, the X factor. 3 billion daily views, but only 0.04 RPM versus 0.12 on Reels. Ad load still at 50% of TikTok's. Music licensing costs, crushing margins. The stock split rumor adds complexity. Last split preceded an 87% rally as retail flooded in. Options show traders are positioned for either breakout to $180 on AI monetization, collapse to $140 on ad slowdown. Most worrying, cloud growth below 25% could trigger sector-wide rotation from tech. Intel's report is effectively a referendum on US semiconductor independence. The 18A process must deliver, yield reality check, TSMC's 2 nanometers at 85% yield, Samsung at 78%. Intel needs greater than 80% to attract customers. Design win pipeline. Microsoft rumored testing 18A for next-gen AI chips. OpenAI considering dual sourcing from Intel. Do D contracts require US-made chips? The nightmare scenario. Yields below 70%. Microsoft confirming TSMC-only strategy. PC recovery delayed to 2026 analysts estimate. 5% upside if yields impress. 20% downside if guidance cut. Most concerning? The 18A failure could trigger a WSTS forecast cut for US chip production targets. This earnings storm hits during peak macro fragility. Fed trap. 92% priced for hold, but dot plot may signal just one cut in 2025. Powell likely to cite sticky services inflation, GDP landmine. Atlanta Fed, now cast at 1.8%. Consumer spending slowing sharply. Inventory glut in tech, retail China. Wildcard, Micron ban expansion could wipe out 5% of US memory capacity, force price hikes on AI servers, benefit Samsung/SK Hynix. The playbook, SPY puts for G, DP hedge gold miners, as rate insurance long volatility via VIX calls most dangerous. Earnings reactions could get amplified by quarter-end portfolio rebalancing from pension funds. Would you like me to add historical analogies to past tech earnings clusters, specific option trade structures, supply chain implications?